So, Damien, thank you for your time today. Appreciate this. I'm going to start with the hardest question of all, if that's okay for you,
Sure.
just to get you thinking about these things. So, as you know, and a lot of our clients are aware, ESG investing, let's use that title as a shorthand, had a fantastic purple period for performance a few years ago, where it outperformed the standard portfolio, if we can call it that, the unethical portfolio. Performance has flipped back around the other way more recently. So talk to us about what's driven that, what's behind that, and then maybe if you could go on to say where do you see it going from here?
Sure. I mean, you're absolutely right. This is the question we get asked a lot. Just reflect back on what has happened, especially in the past 6 years. So we've been doing sustainable investing going back to 2012. When we initially started, we're in a macroeconomic environment that was quite stable. I'm sure you remember, low inflation, low interest rates, relatively low but stable economic growth. So actually, in terms of sustainable portfolios, they tend to do a bit better than the market because the companies that we invest in tend to grow a bit faster, their profits. So they were rewarded by the market by seeing their share price rising. And that changed. Our environment really changed since the pandemic, because since the pandemic, clearly we've moved from one, I guess, crisis to another in a very short amount of time. I mean, you've got a bit more grey than I do, but usually with market, we had a cycle of 7 years. Now cycles maybe have lasted for less than 2 years. And that, I think, is a complete different environment for investors. And you're right, then 2020, fantastic time for sustainable investors. And there was a lot to do with interest rates dropping, because of very low inflation and negative economic growth. So you had obviously governments as well as central banks putting a lot of money on the market. And that was good because when you lower interest rates, this is good news, especially for fast-growing companies. In sustainable investing, you see a lot of those fast-growing companies, and also for smaller-sized companies. Those companies also tends to be rewarded when interest rates are lower. People are happy to pay a bit more for that growth. What we also saw back then during the pandemic was, a huge amount of enthusiasm towards, renewable energy, towards healthcare. I mean, obviously, we're just during that pandemic, and so that was a fantastic time. That completely changed towards the end of 2021, the beginning of 2022, because what we saw, obviously, is that with a significant increase in inflation, because people were just so keen to buy anything they could find after being so frustrated, after the pandemic, then we saw inflation rising. Then central banks had to say, well, hang on, we're going to stop helicopter money. Now we're going to pull back, start doing what we call quantitative tightening, and then rise interest rates very aggressively so that we can cut down on inflation as quickly as possible. And that really was a very difficult time for sustainable investors, because those biases I just mentioned, like investing in fast-growing companies, investing in smaller-sized companies, those type of investment styles really suffered. So you went from a kind of a boom to a more challenging time in less than 2 years. That obviously was difficult, I'm sure, for your clients and just for the industry more broadly. And if you want, this period has carried on, this high interest rate environment has carried on, and actually what we've seen in the past, even in the past 6 months, is that within a couple of months you can see market dropping by 50% and then back, just in the next month. I mean, this is an environment where there is no stability. There's quite an unstable environment where I think investors now really have to adapt. And maybe that will be one of your next questions, is really thinking about, is that very volatile environment one that we'll see carry on, or is it something that actually, are we going back to a 2010, 2020 period where markets were very flat? Where markets were not very volatile?